Hey everyone, it is Jay Soloff here with NetPicks. I'm an option trading coach, and today I want to address how profitable is the wheel strategy. Now, the wheel strategy, of course, is when you sell a put, a cash secured put on a single stock or an ETF or something like that, and you keep selling a put until you get assigned. If it drops below your strike, now you own the stock. You can then sell a call against it, turn it into a covered call, and you can keep selling calls until the stock goes up, you get called away, and then you can get back in with a put again. Hence the wheel strategy, because it's a circular motion of doing these trades. It tends to be a very good strategy, but how do we measure that? Well, everybody does the wheel a bit differently, different stocks, different strikes, different expiration periods. So there's not really a one benchmark fits all for it. However, we can estimate it by looking at a couple things here at the CBOE, the options exchange site. They have these strategy benchmark indices, which are just ways to measure different strategies and how they've done. And so what we can do is we can look at cash secured puts and covered calls in the format that I like to do these wheel strategies and kind of see if they both look good. So you can see here, we're going to stick with the S&P 500. There's also stuff for NASDAQ and Dow and MCI, like emerging markets, and Russell, small caps, things like that. But we're going to stick with the S&P 500. And you can see they have various methods here for covered calls, buy rights, and then put rights. So since we'd be starting a wheel trade with selling a put, let's do a put. These are basically selling weekly puts or selling monthly puts. That's at the money. When I do a wheel trade, I sell out of the money. So we'll look at this one. This is 2% out of the money. So, if it's a $50 stock, 2% out of the money would be $1 down. So you'd sell the 49 put. So that's a little bit closer to what I would be doing. So let's take a look at that. And I'll bring up a chart here. Now keep in mind, this is a very basic strategy. It does the same thing every month. There's no rolling. There's no position management. It doesn't change things based on the environment, etc. This is the most basic way of doing it. Now, if we go back and we look at, say, the last 5 years here, what do you notice? Well, obviously you notice the upward pattern, and you notice that we started around 800 and ended above 1200. This is well over 50% gains in 5 years. Certainly not bad considering the volatility we've had, particularly the inflation period of 22, 23, and then the tariff scare here. So not bad overall, but what I really like to point out about this is how stable it is. Like, you did pull back a couple periods here when the markets got really volatile, but you pretty quickly got back to it. And you can see that it's very stable returns. So that's what I really like. That's what makes this a powerful strategy, is that it lowers the volatility of your returns. So you tend to be making money over time, and even if you have a pullback, you tend to get back there relatively quickly by sticking with the strategy. So this is a pretty neat method of looking at this here with the with the cash secured put. Now, what about the covered call? Glad you asked. Let's go to the covered call section, and it's the same thing here with a buy right. We like to do. We'll just keep it consistent. We'll do 2% out of the money on the buy right. So instead of the 50, writing a 50 call, you write a 51 call, etc. So let's click on that, and we'll look at the 5-year period as well here. Same period we looked at for the puts, and you can see a similar situation here. Now, the difference is when you have a covered call, you own the stock. You own the stock and you sell a call. So there's going to be a bit more volatility because you own the stock, and it is going to mirror to some extent what the S&P 500 is doing. But along with that, owning that stock, you do get the extra upside from owning the shares up to the point of your short call. But here you can see, again, relatively stable upward performance despite a few periods of pretty intense volatility. And you can also see, though, because you own the stock, you also have a bit more upside. So here we go from 2 to 3,500, 2,000, 3,500. That's about 75% return. So higher returns, a little bit more volatility, but still relatively stable, coming back pretty quickly from the downs and kind of consistent moving higher, right? So now we looked at both the put right and the buy right. Both of them show regular upward gains, even in tough environments, down environments, pretty quick to return from the downturns, pretty stable pretty much every time during normal market conditions, right, which is most times. So we have that, and these are just basic, no thought. These are mechanical strategies that happen every month, no matter what. We are obviously going to be doing a lot more research in NetPicks option wheel product, right, which is something I'm doing. I'm running now this new service that is coming out, and we're going to be picking stocks specifically that fit a lot of criteria. We're going to be picking strikes that fit certain criteria, so a lot more selective than this, which will really should boost the returns and the risk versus return characteristics even better. So check it out if you get the chance. That's the NetPicks option strategy. I'm Jay Soloff here at NetPicks. Thanks a lot.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.